Welcome to Ownership by Ritholtz. If you are a business owner, a company founder, a corporate executive, an employee with equity compensation, or anyone who wants to learn more about owning and managing assets, you have come to the right place. In this episode, we're talking about why real estate investing is so important to wealthy families and why right now could be an incredible opportunity in the space. Just a reminder, this conversation is for informational purposes only. It's not a solicitation to buy or sell any investment, and it's not advice. All standard disclaimers apply. See the video's description for more. My guest today is John Chaffetz. John is the co-founder and principal of Timberlane Partners, a Seattle-based real estate investment, development, and asset management firm specializing in value-added multifamily properties across the West and Mountain West U.S. markets. That is the longest sentence I've ever read in my life.
My apologies.
One of the prior to founding Timberlane in 2011, John began his career in proprietary investments at Morgan Stanley's commodities division, gaining experience across energy, shipping, and carbon credits. Welcome to Ownership, John. Happy to have you.
Glad to be here.
Okay, commodities to real estate is sort of unexpected. Tell me more.
Wow. Yeah, it was unexpected for me too. I wanted to be a trader. I thought that's where all the big bucks were getting made. That's what I should do.
That's what most people start out as wanting to do.
On my first day, maybe second day, one of the people who ran my office took me aside and he said, "You're not a trader," which was a huge bummer. But actually, I think he was pretty insightful. And I thought he was firing me, but actually what he was doing is he's saying they had a desk that was focused on buying assets. So wind farms, power plants, and assets that the energy desk could trade around. And so very quickly, all of a sudden, instead of being a desk jockey trader, I was like going out and doing due diligence and looking at assets, which is actually very similar to what we do today. So there was a funny backdoor angle into.
He saw you as more of an analyst or a portfolio person and less of a person on the trigger.
Yeah, more of an investor, analytical person, strategist, exactly.
So it sounds like he did you a huge favor.
Huge favor, and we still know each other today, so that works out.
Okay, so first things first, for people who are unfamiliar with Timberlane, how would you describe the firm's investment strategy and your overall mission?
Yeah. So we are as you mentioned in your intro, we're a Mountain West and West Coast based real estate asset management firm. Currently, we have strategies that are focused on multifamily acquisition and development. That's our bread and butter.
Multifamily's apartment buildings.
Yeah, rental apartments, let's say. For us, the scale, we would typically be on the more institutional scale of those things. So 200 unit plus type product, sometimes less, sometimes a bit more. And we are primarily active in Washington, Colorado, and Utah. We've done some business in California and Texas as well. And our mission really is to lean into that narrative and become a market-leading firm in the West and Mountain Northwest with a variety of products, including acquisition and development, maybe credit as well. And we focus, and we really want to be kind of a household name among kind of high net worth and ultra high net worth investors and the wealth management groups that work with those folks. That's really where our lane is today, and we want to try to lean into that more with other products and better offerings along the way.
So we're going to come back to that region of the country and why that's important to the story. But I wanted to ask you, you used the term institutional quality execution with local expertise. What does that mean in the context of investing in real estate?
Yeah, so for us, our client base include some extremely successful and sophisticated individual investors. Maybe they're in the prime of their career. They might be wherever they work. They're earning money. They're investment professionals for the most part, and so they're not that interested in working with their buddy who's buying an apartment building down the street and seeing how it turns out.
Right.
They expect that their money is going to get managed in an extremely professional way. On the other hand, they know that the mega institutions that often manage their money really are kind of delivering almost like a market beta strategy by being so big. Like if you're a household name wirehouse type real estate investor and you have to buy, hundreds of millions of dollars, billions of dollars of assets in every single market every year, it's really hard to imagine that you're going to outperform or do anything particularly innovative.
You almost are the market.
You are the market.
At that size,
yeah,
you are the person that's determining what the growth of the market is.
So they don't want that either, right? It's very comforting to know that a public company is managing your money in certain ways and not in others. So what they expect from us is the same thoroughness that an investment committee at a wirehouse shop might have or a big institution would have, meaning we really look, we have rigorous underwriting, real due diligence, and actual thesis, all of those things. But that we don't have to buy every deal that comes our way. We can be super selective and act really aggressively on the ones we like the most and react to market changes. We can update our investment committee criteria in a week. It might take a company that has $80 billion under management, might take them a year to realize that like an opportunity has presented itself that they don't understand. So they want the nimbleness with the thoroughness, and that's really
okay. So you guys can spot a dislocation in a given market.
Yeah,
know that there's a big opportunity. There's a very good chance that because you're not covering the whole country, you have the resources to really understand a particular neighborhood.
That's right.
What the fundamentals of that neighborhood are. And that will inform you'll be able to move quicker on a property. Either say no quickly or say yes quickly.
That's right.
And know the right pricing. And that gets lost in this like institutional realm where we're talking about $5 billion funds.
Yeah, at mega scale, it's hard. And by the way, there's lots of amazing people who operate funds like that. It's no knock on maybe different source of capital than what we focus on.
Yeah.
But for us, where our investors are sophisticated and they say, hey, like I can make high single digits in the liquid stock market, the S&P 500 or something. I want to do meaningfully better than that with my illiquid allocation.
Right. If they're giving up the liquidity,
I want to get a better return in exchange.
There's got to be a better return that comes from that.
That's right. And so they rely on us to be really selective and find things that really stand out and know how to lock those deals down.
One of the things that sets you apart from the other end of the spectrum, the hobbyist real estate investor, you do have some scale. And you are very dominant in a lot of these markets, which is something that, most people whose brother-in-law is going to buy a building that's got 3 doctor's offices in it. Like that's not even in the same realm of what you guys are doing.
Yeah, not at all. I mean, by the way, we sort of jokingly say that when we got started, my partner Dave and I we were 2 guys in a truck.
Yeah.
We literally were often in a truck.
We all get started. We all get started that way.
The good news is Dave grew up on a farm, so oftentimes we really were in a truck, driving around the suburbs of Washington. But yeah. Listen, small mom and pop investors can do really well, and some do extremely well. But we also are not at that scale either. We're rough. We're putting out hundreds of millions of dollars a year. So we're past that sort of part of the cycle, if you will. We're operating at a more professional level, and in that level, what our thesis kind of is that it's very competitive at the doctors and lawyers level. Meaning, if you're trying to buy a 10-unit apartment building that's down the street. We have a lot of clients who used to do this and then they got crushed, right? And so then they're like, oh, maybe I should work with a professional. Where they might buy something that 3 buddies can buy, and then they don't think about the fact that this isn't like buying stocks, right? These are management. Yeah, it's not as bad as buying like we've done some hotels as well. That's truly an operating business. An apartment building is easier to run than a hotel, but it's still a business. It has employees, it has marketing. These days, the marketing and the branding of the housing itself is extremely important.
Yeah.
So to get all that stuff right as an amateur is really difficult. So I
wanted to ask you, I wanted to go a little bit further on that. Do you have a customer-facing brand in these local markets where people know you as the developer or the manager of these properties, or is it more important for the building's brand to shine through? And you guys play like a role in the background as investors.
It's more the background. So we own properties in a couple of different markets.
You could be like John Chaffetz, the apartment king of Seattle.
We have
That's
avoided
another
that.
way you could go.
Yeah, no marketing person has told me that that's a good idea yet.
Okay.
And so
you could have that for free.
Yeah. If that turns out to succeed, I'll let you know. But we own some suburban product, we own urban product, we own a variety of different products in different markets, and so. Our theory is that people want their housing to be unique to a point, right? Like they don't. So we try to treat every asset, which usually our assets are big enough, like they're usually $50 to $100 million assets each one, that you can really look at it as its own product. And we do a fresh brand.
So it has a name. It's not like 323 Elm Street. It might be like The Elm.
Yeah,
but
it might
people
be The Elm.
say so people in that area, let's say a wealthy suburb in Washington State.
Yeah.
People they're out to dinner with their friends or whatever, and they say, we just bought a place in the something.
Yeah,
it's crazy, but like that has more meaning than ever. I don't know what that's about.
Yeah.
If it's social media or people like to be in a building that has an identity, and an identity that in their eyes makes them feel better about like their station in life. People are like that.
Yeah, you want to have an aspirational brand with
Yeah.
whatever the product is, I think, as a way of saying what you're talking about. And for us, that means investing in the amenities, and we just put a golf simulator in one of our new projects. People love it. But that's also why I think if you make it like too cookie cutter, people are smart and they recognize that and they're like, oh, this isn't authentic. This is not. And for example, if you own an apartment building in Salt Lake City and you own an apartment building by the water in Seattle, like it's just the character of those neighborhoods is completely different. And so you want to have different artwork, different color palettes, the whole thing. And that's my point. We treat that with a lot of respect because we have had some hospitality experience in our background. And so my wife owns restaurants today. So we try to be a little bit more creative about it than a typical landlord would, let's say.
Yeah, have it be of the area that it's in.
Yeah, without being too trendy. That's right.
Okay. I'm very familiar with that idea as a recent condo purchaser in Florida. Very different than Seattle.
Very different, right? Like you couldn't have the same product in both places.
No, certainly not. But we walk around town, and when people ask, where do you live? And we say it, they say,
know it.
Oh, yeah.
Oh, that's a nice
I
building.
know what that is.
Right.
Hopefully they say that. Yeah. All right. I wanted to ask you just like big picture. Here's one of your quotes. You said, the current market presents one of the best opportunities we've had since our founding to buy excellent assets, high quality, well located, and in markets we love. Institutional capital remains largely sidelined, and the unfortunate seller in today's world must deal with private buyers like us who expect to earn an enticing return. So it sounds like you're saying it's a buyer's market.
I would say so.
There are not a lot of other buyers right now. There's a lot of people just like, I don't know what to do.
Definitely.
And that's an opportunity for you guys to get the prices that you want because A, you know what you're doing, and B, you're willing to move relatively quickly when somebody needs to sell something. Do I have that right?
That's very well said.
Is that a national situation, or is that unique to the areas of the country you operate in, or a little bit of both?
I'm glad you asked the question because I think I was thinking about coming in here today, like what is something that's critical to emphasize, which is that I think the patterns that we observed when I made that quote are happening or will happen every place in the country, but they don't happen at the same time. So, for example, 2 years ago, when we were buying very heavily in Washington, we bought more rental units in Washington State than any other group in 2024.
Really?
We were the number one buyer, which is somewhat.
Did you ever worry? Wait, why isn't anyone else buying?
Well, I think you could. I think if you held that stat every year, you definitely would. Okay. We felt very good about doing it that year.
Okay.
Because it's not because we bought so much more; it's because everybody else is buying less, which is really the nature of this question: is where are the other buyers? But what I was going to say is, all the U.S. underwent a construction cycle that was super turbocharged at the end of the last cycle. So coming into COVID, probably the construction cycle on its own would have been slowing down. There tends to be a 10-year cyclicality to how units get built and then rented. But instead of slowing down, we injected a huge amount of cash into the economy and lowered interest rates even more. So there was this like extra cycle, a couple more buildings that got built everywhere. Everywhere you go, there's more cranes than ever, right?
I've seen that phenomenon in Austin and in Nashville where they're probably right long term with the level of building, but it's definitely a glut in the short term.
That's exactly right. So 2 years ago, the glut was in Seattle, and that's where our home base is. It's not the only place that we invest.
I think Amazon hired 1 million people in extra people in the pandemic.
Yeah, not all in Seattle, but yes, huge hiring happening.
Yeah.
But it was more too many units getting delivered, right? And so there's just only so much absorption that a market can handle.
Yeah.
I read an article the other day about Phoenix, I think, where they have pretty elevated vacancy in that market, and it makes you think that there's something wrong with the economy of Phoenix. But actually, if you look at it, they've rented more units than ever. They're renting more units than ever, but they have too much inventory.
Yeah.
So what I was getting at is we sort of started to see this cycle where, and we felt it starting on the coasts, so California, Washington, to some extent New York, Boston, where there's just too much supply and you start to see really difficult stats like vacancy, rent levels are declining, concessions, what we call concessions in the market. So move in, I'll give you 3 weeks.
6 months free,
yeah, hopefully not 6 months,
We'll
God forbid.
We'll
but yeah,
turnkey the,
we'll give you a free TV and read, whatever. Whereas the places like Austin and Nashville, some of the places that got really hot in the last couple of years, were still like holding on. And so our home market basically started to fall apart. And that's when that quote was offered. Now things have flip-flopped. Like we don't really have a supply issue in Seattle anymore. So we're starting to see, it got absorbed and we're starting to see.
Boys, slide 12, please. So I think that's what you're showing us here.
Right.
So you have this tightening supply at the same time that demand is starting to surge, and you call this a once-in-a-decade window.
Yeah, and so the shape of this graph, basically the main thing is that the blue line, which is the amount of units getting delivered, you can see has fallen off a cliff.
Yeah.
And so, supply and demand, a lot of people don't believe in it, I guess, anymore, but I still do.
Yeah.
So you probably do too. So
with housing, yes.
Yeah. So the supply of units has dropped, and as a result, we're getting much more robust rent growth in Seattle than we've seen in a long time.
The green line is rent growth. So that's how much you can get for each unit on an annual basis. Why is that doing what it's doing?
Well, so
why is that racing higher like that, or at least the projection?
Okay, the demand there's always an exception, but all the cities we've thrown out in this conversation, plus many more, Seattle, Salt Lake City, Denver, Austin, Nashville, Miami, these cities all have some common features. They have really exciting demographics. They have job growth. They have population growth. Not like exactly the same,
but corporations.
But they've got great employment pictures. Yeah, diverse.
Multiple industries,
all of the above.
Yeah.
That's one comment. The second comment is, in general, homeownership is becoming more and more out of reach, right? So we don't have a slide like this, but I can provide you one. In general, the homeownership rate in this country just continues to decline. And it's not all because some of it's cultural. Like my brother, he doesn't want to buy a place even, right? I mean, it's just so there's some.
Well, that's good because there aren't any.
There's cultural factors.
Yeah. No, we don't have enough. We know we're 1.5 million houses undersupplied on an annual basis every year. It's just
so that stat puts pressure on rentals, right? So all of that. The combination of those favorable demographics
upward pressure
creates demand. It creates sustained demand for rentals.
Yeah.
So unlike a lot of other real estate asset classes, office, for example, like the basic demand for rental housing is fairly consistent and rising. And developers know this, which is why we develop whenever we can. However, if you develop too much, then you tank the market and you get higher vacancy and you don't have enough pricing power on the rent side. And that's what is now happening.
It takes years to work through, and then before you know it, there's not enough.
But once you absorb it, then you start to get rent growth again. And the problem with it, or the opportunity, I would say, for our investors and for others, is that it's like restarting a nuclear aircraft carrier or something. Like you can't just start delivering units next year because you see a shortage. It takes many years. Like if we are starting to buy development land ourselves, for example, those units are not going to deliver till 2028, right? I mean, we have to buy the land, or at least we have to buy the land. That takes months. You have to entitle the land. That takes a year. You got to build the project. That takes 18 to 24 months. So the second that you see the supply and demand being out of whack, it takes many years to fix. That's why the construction cycle is so cyclical. So that's what that graph shows. Is that we're now on the rent upswing. You guys are
buying ahead of that sweet spot where
ideally
where rents are going up, but supply is not hitting the market anytime soon.
That's right.
And you have this basic run for the roses between now and when the market catches up and adds enough supply.
In an ideal situation, as a multifamily investor, you want to be holding or selling your assets in those periods of unit shortage, right? And so anyway, going back to your original question, even today in the Journal, there was an article about how soft it is in Austin now. Now, that's not what the article says. It doesn't say rent's soft in Austin. What it says is it's a renter's market and it's going to stay that way for a while. That's the headline, like as if it's the same story across the United States, which is the reality is in some high-profile markets, that's true. In our hometown market, that was true maybe a year and a half ago. It's not true as much anymore. So my point is there's an opportunity to follow that story of oversupply and look for high quality markets where, hey, there's nothing wrong with Austin. I don't think Austin's
the media covers real estate, not the real estate media, but the mainstream media and even the business media covers real estate like it's a stock market where we're all in the Dow Jones.
Right.
Meanwhile, real estate
It's really 1,000 little markets.
Is a local thing.
100%.
Okay. Even back to Florida, it's all about Miami has all these vacancies. Okay, but like 30 minutes north, Fort Lauderdale doesn't.
That's right.
So it could be that hyper local.
Oh, yeah, for sure.
I think the media, they like skip over that nuance because it's not important to their readers. But if you're investing in the space, it's very important to understand that difference. That's
100% right. And even within the same city, you can have too much supply in one location. Even in the peak of the oversupply of Seattle, we were still focused on submarkets within Seattle where we didn't really see as many cranes. Like we always want to buy where there's less competition.
So I want to ask you about your investors. This is the ownership channel. We talk to people who are asset owners.
Right.
Want to ask, what is it about investing in real estate that makes it so essential for the portfolios of wealthy people?
Yeah.
So I would point out, not everyone who invests in real estate is extremely wealthy.
Sure.
But everyone who is extremely wealthy has real estate investments.
No question.
So you started as a commodities trader.
Yeah.
So you've seen other investment markets. What is it about real estate specifically that makes it so important?
Great question. I think it's a very timely one. So
I'm very good at this.
Yeah, I can see that. So, and you guys probably have to, you probably have to give advice to people all the time about like, oh, the stock market, what should I do, right? And that I think is a good way to frame up your question. Obviously, one of the benefits of being in liquid markets is that it's liquid. But the downside is that it can be very volatile. It can get irrationally overpriced, in my view, sometimes, let's say. And if you have a big chunk of money that you invest or that you're saving, your wealth is being invested, I think it's very, very helpful and comforting for people in that cohort who have the ability to park some money for 5 years at a time, right? If you buy an apartment building and you decide you want to buy a car, you can't call me and ask for your money back next year to buy, that money is parked. But in exchange for that, they get much higher return, generally speaking. Like the goal of investing with groups like ours would be to put some money in an asset class that's significantly outperforming what they get in their liquid investments. You obviously have to be privileged enough to have enough money to put to the side to do that.
Right. So right then and there's a barrier to entry. You're not competing with every investor because every investor doesn't have $1 million check to write.
Right.
So right then and there, that sets up the first barrier that should theoretically lead to higher potential returns.
Yeah, so you're basically, people who have enough resources can trade some liquidity for higher return, and that's something they do. The second thing is it's privately invested, so it's not subject to we're not marking assets. They're not looking at their statement from us and saying, oh my God, I lost $10,000 today.
I think that's an underrated, in a year like 2022, you see your shares of Amazon cut in half and Meta is down 70%. I'm sure your real estate's not up, but you wouldn't know. It's out of sight, out of mind. And,
and you wouldn't.
And it has
even,
no ticker on it.
And you wouldn't even. And maybe you wouldn't even care if it's sending you a check every quarter.
Right.
Right. And that's the point. Is most of the stuff we do it's intended to be income generating strategies. So the returns that we generate over a 10-year period, let's say, with some deployment of capital, hopefully is made up in some proportion of dividends that we've issued. Let's say mid-single digit or higher dividends.
Are you passing those through during the course of the investing period?
Quarterly.
Okay, so it's cash flow investing.
Right.
And in that scenario, provided the cash flow is there, you're not worried about what is the value of every building
certainly
in my portfolio.
Right. Certainly you're worried about it a lot less than if you're just thinking about what it's worth.
Right.
If it's making money and it's a carry positive trade for you, then they can trust us to wait till the best possible time to sell things. We sold a lot of assets between 2019 and 2021, and I'm glad we did, right? Because then things got really valued much lower after that. So I think ultimately to your question, there's other reasons too, by the way. Also, people view it as a inflation hedge, right? So that's been a topic of varying excitement for people depending on
rents should rise in excess of prices in the economy. At least historically they have.
And historically
or at least kept pace.
Historically they have, or at least kept pace. And if material goods go up, then that also means that the cost of construction goes up. That means that the rents have to rise higher in order to justify construction. So there tends to be, at least historically, conceptually, a link between those two things. When we started in 2010 buying things, that was one of the biggest narratives. We had investors coming into us at that time saying interest rates are going to go up, which is the opposite of what happened, by the way.
Yeah.
But we want an inflation hedge. And so that's a big element too for some of these folks.
We then had 10 years of deflation.
That's right. That's right.
Okay. I want to come back now to why you invest in the markets you invest in.
Oh, yeah.
Boys, can I have slide 15, please? So Seattle is an example here. You're calling it the number 2 tech market in the country. It's Microsoft, it's Amazon, it's a whole host of startups and other well-known tech companies are there. Alphabet's there, Apple's there, et cetera, et cetera. Population and job growth is twice the national average, I would imagine, because of all the economic opportunity, not the climate per se.
Yeah.
Okay. But also it's the right industries. It's AI, it's life sciences, it's where the jobs of the future will be. So if you're putting up a building and expecting tenants that can pay the current rent, higher rent later, that's like, it seems so obvious. Why wouldn't everyone do that? But you guys have isolated these markets very specifically based on the incomes of the people who live and work there, the types of companies. So talk a little bit about why your markets are your markets.
So I'll answer it generally and then specifically. So generally speaking, I think it's very important for firms like ours to become experts in a relatively tight number of places. So I think we can maybe talk about it later, but like local expertise in any market, Tampa, doesn't matter where, but deep focus on a specific location is a huge advantage. So I'm in that sense, like I don't necessarily aspire to doing what we do in every market. Okay. Why we've chosen these markets. Originally, back when we were 2 guys in a truck, it was truly, admittedly, happenstance. My partner Dave grew up in the Seattle area in a real estate family. They had his dad and he had done real estate projects similar to what we do, a little bit smaller scale, for decades prior. That's the reason we started there. But very quickly,
now his father was Kurt Cobain.
Man, I wish.
What era? How old are you guys? You and Dave?
I'm 42. Dave's 47.
Okay, so that's the right era.
Yeah,
right.
I mean, I don't think Dave's dad was a farmer in a very rural area who probably never even heard of Kurt Cobain, but Dave certainly has.
Okay.
So what was interesting is that I was a New Yorker starting to do real estate deals in Seattle. And my perception of Seattle when I got there in 2008 was like, oh, this is kind of a secondary market. It's very, very affordable. Amazon was just in one building, right? So it wasn't at that time. It was a much different company than it is today.
Dude, they lost their NBA franchise around that time.
Yeah, that's right. Everybody was bemoaning that.
It definitely had that vibe to it. They lost Boeing.
But very quickly, one of our real, better to be lucky than good. I like to say it's better to be lucky and good, obviously. But because of my Rolodex coming from Wall Street was full of more professional investors. I wasn't just trying to raise money from like any random person. There was a lot of interest in Seattle that I was very able to quickly build momentum in our investment community, even from people not in Seattle, about that market because of the quality of life, the emerging tech scene that you described, and the relative affordability. The relative affordability is a huge carrot. There's a huge criteria for us, which I'll explain in a second. And then the last one, which people think about less, but now in places like Austin and Nashville, they're thinking about all the time, which is it's not that easy to build housing in the markets that we focus on. So Denver, Salt Lake, Seattle, these are places that are relatively supply-constrained markets.
Glut resistant.
There's water, there's mountains, there's nasty winter conditions. It's just an expensive, difficult place to build, which means that the boom bust.
So where is it easy to build? Is that Phoenix?
Yeah, Phoenix, Houston is
famously endless land.
Famously difficult.
Vegas.
Famously easy in Texas, right?
Yeah.
Where these are, and by the way, like the way to say it is in a certain way, the markets are more efficient there. Like if rents go up, people immediately build a lot of units, and then rents stop going up, right?
Okay. So this is the opposite of that.
We like to invest in areas where that dynamic is less the case. for geographic reasons, political reasons, all of the reasons. Like it's not that easy to entitle something in Seattle. And that just means that it's harder to build, which means that the sort of uniqueness of what you own is higher. So our initial investment base of investors really got this pretty quickly, right? There are people who are based in New York or LA, and they sort of saw how the old real estate money in these towns were made. It's like they're not making more land in Manhattan, right? And that's one of the reasons why the real estate fortunes are so great here. So anyway, same thing. We really initially focused on these smaller, high quality of life markets where the rental affordability was very attractive. To give you an example, even today, in Seattle, the average rent is roughly 20% of someone's take-home pay. Still today.
Okay.
In places like New York, is like
it's 110%.
Yeah, yeah. I mean, a lot of places, a lot of gateway markets, San Francisco, New York type places is like 50% or maybe even higher.
Yeah.
Right. So that criteria is very important for us. Like home ownership has gotten very expensive, but
why is that important? Less churn within the buildings. People can afford to stay.
It's more like it means that people can afford to pay the rent. Okay. Right, which is good. That's a more healthy rental market, if you will, right? And it also means that if there's less supply and rents start to go up, we can charge more rent that our tenants can afford to pay it, right? Okay. That meaning like some people talk about this at some point, like, well, what happens if you raise the rent too much and someone can't pay it? Yeah, that's a problem. If you're in a market where that's a dynamic, then that's an issue.
Right.
We try to focus on markets where that isn't an issue. And then there's another kind of slightly more practical reason, which is just that the Northwest, sometimes it feels like it's its own country a little bit. I was talking with a wealth management firm the other day, and the gentleman I was speaking to, his wife is from Seattle, and he was like, yeah, it's kind of like its own country up there. It's not nearly as overdeveloped with people like us. Like there's a lot of firms like what we do in the Sun Belt, right, and certainly in the Northeast and in LA, California.
Yeah. Why do you think that is? Like it's just like it's a proximity
thing.
It's a great
question.
It's very remote for New Yorkers to get there. It's a 7-hour flight.
I mean that's probably what it feels like. It's really like 5.5.
Yeah.
But it feels like 7, right? So I mean, Stotts has to do it. Who works for me?
Well, I'm 6'2", so everything feels like 7 hours when I'm on an airplane. I could barely move.
It's far, yeah. So I don't know the reason why, but we've leaned into it and that's in terms of our mission, like our goal is to sort of put those places on the map and be one of the firms that does that.
Yeah, no, listen, it's an amazing part of the country. We actually have an office there. We have a very talented certified financial planner, Joey Fishman, who's in Bend.
Oh yeah, Bend's great. My brother lives in Bend.
So he's on his bike all the time, and it's like it's its own thing, all over Washington State. You guys have a slide, Daniel. Let's put this one up. 17. You're just talking about the Washington market in general. Newly redeveloped waterfront park. FIFA is coming in 26. Sexy vampires. What else is on here? Professional sports teams. I think you're going to get the Supersonics back in the next NBA expansion.
There's a lot of work for that to happen.
There's
a lot of people working on that.
It'll be an Amazon or a Microsoft executive.
Somebody like that will take care of it.
Okay. So, all right. I want to make sure we get to Denver and Salt Lake because I know there's two of the other areas that you focus on. Tell me about Denver.
Well, I mean, maybe we can talk about them sort of together.
Yeah, sure.
Which is, like I said, those states are contiguous, right? So we definitely we want to run a business where if somebody calls me and says, "Oh my gosh, I found this incredible deal in Poughkeepsie," I'm just not going to go there, right? I mean, it's too far for me, and that matters.
No tech companies.
Yeah, even if there were though, like pick Alexandria. Let's make a more real example. Okay. Alexandria. There's tech companies in There's a lot of exciting reasons to invest in Alexandria, for example. But there's somebody like me that's already there, like right. So I don't. There's somebody like my firm that is already deeply focused on.
So this is a really big part of the opportunity in your eyes. That ability to you call yourself a sharpshooter in these local markets.
That's right. Okay. So I think a lot of our investors who have millions of dollars of liquid net worth to invest in things like what we do, they have a choice. They can choose between a firm that just invests in multifamily in the United States. Or they can, and that's obviously less work for them to write one check into that type of an allocation. Or what I think they increasingly do is they realize that like, hey, there's firms like Timberlane in different markets who really are better in those markets than the national platform, and I'm going to figure out who they are. So for us, there's an important definition standpoint of what markets are we in? Are we in enough markets to provide diversification without being in so many markets that we just can't effectively cover them?
Right.
So we started investing in Salt Lake City 2013, relatively early for an out-of-state firm. Salt Lake became pretty hot as an investment
Goldman's
market.
there, and
Exactly.
Right.
We sort of overlap with Goldman getting started in Salt Lake, and that's what brought us to Salt Lake. And at the time, everybody was saying, "Oh, Salt Lake's eventually going to be like Denver." So there was kind of a hey, let's copy what happened here in Denver. There's some big differences between Denver and Salt Lake City, but they share the same physical issue that we have in Seattle, which is that they are much more difficult, supply-constrained markets. Denver, slightly less so, right? Denver's got some room to grow, but it's a more mature market as well. Not as much infill. And they both have that exposure to the right kind of economic diversity of opportunity. You said all the sectors. Life sciences, technology,
right? Like Denver
energy.
threw off all these like tech startups coming out of UC Boulder, and they have like their own startup ecosystem. It's very vibrant.
There's an
culture.
energy business there as well. There's some commodity related.
Yeah.
In Colorado has sort of like energy and minerals and natural
right.
resources.
So they can attract young professionals and people working in stock option compensated companies, and that's like a great place to have rental apartments
extensively.
Okay.
And so for us, we sort of looked at, hey, what are the big markets, big-ish markets within a certain radius of where we are that feel consistent with what we do, and Salt Lake and Denver were the obvious kind of places. If you the same graph you showed earlier, Denver has the exact same projected unit shortfall coming. So does Salt Lake City. So they have the same.
What do the incumbent operators say when you show up and start taking property? Do they even know who you are, or not really?
Well, I'll tell you that when we started to buy stuff in Utah, which is historically a very clubby market, difficult to penetrate. I mean,
there are cultural reasons.
Yeah,
for
there's
that
strong
too,
cultural reasons that you can imagine what they are, but we're really very very entrenched there. But we basically were told like, hey, if you want to buy something here, this is 2013, we're going to let the market price it, and then you're going to have to pay 5% higher if you want to buy it. Like,
why?
Because they just were preferring to trade inside their own community, basically, and
like
so
the Mormon wives.
Yeah, okay. I mean, I don't know what happens behind the scenes. I just know that it was kind of like, hey, there's people.
It's all on TikTok now.
It was like,
see it.
It was like, hey, there's people who buy and sell in this market, and you're not one of them. If you want to be one of them, you're going to have to pay up. Now, we did that in 2013. We paid. This is as an investor how you have to become thick-skinned. We paid the most per unit to get into Salt Lake in 2013. We paid the most per unit that anyone had ever paid in the state of Utah before up to that point. Like, that was basically like, this is the price of admission.
You paid your initiation fee.
Yeah, no, that deal
but then you're in.
That deal was a phenomenal deal. Like, the whole market was priced way too low.
Okay.
Right? That's what happens sometimes when you're dealing with like local market dynamics, right? Is that it's just getting priced by people who know each other, who for them par is this. Whereas we're saying, hey, Salt Lake City is on the up and up. The rent is so much cheaper here than any other major metro within 500 miles.
So you said we'll pay that.
We'll pay up because
happily.
we think rents are going to go up. Yeah, and so that deal, I mean, it's probably worth more than double now than what we paid. We sold it. We if we still owned it, we would be. I mean, we'd be thrilled if we still owned that property.
What's the next up and coming city where you guys look at and say this might be something for us, or the next region, or are you not really worried about that?
I mean, we're always worried about it a little bit. We always say to ourselves, if some city in the United States blows up,
it's nice to be early.
Yeah. That's one of the great ways to make money.
Yeah.
If it's I mean, what we say is if some city just comes out of nowhere and just does phenomenal, and it's really, again, it's in Virginia, I'm not going to kick myself about that, right? Because that's just not part of
It's not even contiguous to where you're operating.
But if it's in our backyard, then we feel like we should know about it, right? And so we definitely, I mean, there's already been a lot of traction in certain other parts of the Mountain West, Boise, Spokane. Those are much smaller markets than the places we focus on. But
They
they've
had
done
little
really well.
boomlets during the pandemic, though.
And they're great cities. They're like Bend. They have really high quality of life and actually pretty robust employment. There's some really good groups that operate in those markets already. So those are a little bit more like niche for us, but we do look at them. A little further away, but I think we're watching the Texas markets very carefully. Again, that's kind of at the outer rim of our geographic look, but we do have assets in Texas already, and we work with some families that are based there. And I think that I guess I'm not as focused right now on where's the next cool place. I'm more focused on which are the obviously great places that are getting underpriced.
Okay.
Right. That's more what I think the obvious opportunity is going to be. And Austin's a good example.
Right. You don't have to predict the future that way. You can just look at the present situation and say this is an opportunity.
Yeah. I would rather buy something that I know is a fundamental performer when it happens to be at a low point in its valuation cycle than try to be a first mover in a place that I don't necessarily understand.
I have two more for you. I want to ask you how interest rates affect cap rates. And if you wouldn't mind, a lot of my viewers are not real estate investors and could use a little bit of overview on why cap rates are the operative way of looking at these types of investments.
Happy to. Yeah, I wasn't sure whether you want me to start using the lingo or not. So I'll.
I think about it like a dividend because I'm a stock person.
Yeah, that's
so I just take the value of the building, divide it by the cash flow, and it's like this is my cap rate. But then there's a component to this where as rates come down, that will change, and I think that's kind of apropos for people who are thinking about putting money to work in that environment.
I think the way to think about it, and if I need it to be, if you need it simpler, just tell me. But you can think about the cap rate as kind of what the yield is on the purchase price of an asset on the day that you buy it, based on what it did last year or in the preceding 12 months.
The cash flow that it threw off last year in rents.
So if a property made $100,000 in the last 12 months of profit, and it's a 10 cap market, 10 cap market means 10%. Then you would have to. Then the pricing of that asset would be $1 million, right? Because in $1 million asset, if it yielded 10%, would give you the $100,000. So that's what a cap rate is. Because it's a cash flowing instrument, then it tends to price relative to other cash flow benchmarks, like the 10-year
risk free rate,
like the 10-year Treasury, for example. Right. So a lot of people, correctly assume that cap rates and the 10-year Treasury have some relationship to one another. Because obviously, if the 10-year drops, then we have to talk about leverage also, because it's relevant partially because you're looking at what the risk-free rate returns. So you should be returning something better than that because it's not risk-free. That's one intellectual reason to look at it. The other one, though, is because these strategies are always leveraged. Meaning
you have to borrow money to buy something.
There's always borrowing, right?
Yeah.
So if you're and our borrowing profile is fairly conservative. I think in general we're kind of 60% leverage type shop. Some people borrow much more. You can make a lot more money if you borrow more, but obviously you can lose more money too.
So you'll be 40% equity of the building,
debt, right.
the day of purchase, and then over time that will come down.
Right.
Or not necessarily.
Yeah, sure. Over time, right. In theory, when you sell, there should be much more equity than when you bought. So yes. But so what I was going to say is, so even if you don't care about the Treasury cost, about even if you're not thinking about the risk-free rate, if your borrowing cost goes down, then theoretically you could pay a little more for the asset that you're buying. So that's another reason why, just from a functional standpoint, when interest rates drop and you can get a cheaper mortgage, sometimes people will get more aggressive on pricing. They don't move lockstep the way that you would expect.
Nothing's ever that simple.
And the reason why is because let's say that an asset made that exact example that I made $100,000 last year. But then you, as potential investor, read something in the paper that says, hey, right across the street from that building, XYZ company is about to hire 10,000 people who all make $1 million a year. Well, if you know that, then you're going to think the rents are going to go up around here. So in that situation, the cap rate that someone's willing to pay will start to drop. Right. So the other thing I'll say is the more anticipated rent growth that a market has, the more expensive the cap rates will look, the lower the yield that someone is expecting to make on the first day.
The buildings become more expensive, and therefore the cash flow coming out of it proportionally is lower.
The stock analogy for you is if somebody publishes a super exciting earnings report, or like you think the growth prospects are really attractive for a building, then its stock, the PE ratio is going to go up. Right. It's so that's the equivalent.
People are willing to pay up for it.
People are saying, "Well, I don't really care what the cap rate is right now because I can see where things are headed, and I'm going to try to buy it early."
Okay.
Right. Does that make sense?
Yes. The last thing I wanted to ask you is how do people get money into your funds? So you work with family offices, you work with wealth management firms like mine.
Yeah.
Institutional investors. What does it typically look like to do business with you guys and put money into your funds?
Yeah. So I think I don't know whether I guess you gave a general disclaimer. This is just
we're not telling people go put money into the fund, but how do you work with investors?
What I would say is we run funds. That's our primary structure. And we work with individual investors.
How often do you raise a new fund? I guess would be the question.
Every couple years.
Okay.
Yeah.
So now you're ready for the next set of investments. You're raising the new fund.
That's right.
Okay.
And we typically either work with high net worth investors who we know, or we work with wealth management firms. And increasingly, that's a big focus for us because it's harder for people to. I mean, it's a better arrangement, I think, for us in general to build relationships with professional wealth managers who then have their own client base.
Right.
Then
you're not all of somebody's portfolio, and you don't have to disseminate the same information to 20 people.
Yeah,
you have somebody that can do that on your behalf.
Yeah, that's right. And then what was it? Well, there was a second part of the question. How do we meet? How do people work with us?
Yeah. How long do these funds typically go for?
The fund life is in general for our funds. First of all, I should mention we do acquisition funds and we do development funds. We haven't really gotten too far into that.
Okay.
But the duration of the acquisitions funds are 10-year funds. So typically they generate liquidity in the 6 or 7 year range, but we have a few years at the end just as a buffer.
Yeah.
And the development funds, the timeline is a little bit shorter, right? Because we typically buy sites, build the sites, and then sell them. So that's kind of a 5 or 6 year horizon. I remember what I was going to say. In working with wealth management firms, we put ourselves onto the Schwab and Fidelity and Pershing custodial platforms. So we've tried to make it as easy as possible for people's wealth management firms to be able to interact with us.
So they can allocate through the custodian that they're already managing their clients' money.
It doesn't have to be some bespoke. It doesn't have to be some kind of bespoke relationship.
Right.
On an individual basis, we have bespoke relationships with people once we get to know them.
Well, listen, I want to just say thank you for coming by and explaining all of this to our audience. I know there's a lot of curiosity about real estate investing amongst people who aren't already doing so. I think it's got a lot of benefits relative to a portfolio of all stocks, and I think you hear that all the time. So thank you so much. And I want to let people know where they can learn more about your strategy. What's the URL? Where do we send them to?
Yeah, so our website is www.timberlanepartners.com. It's Timberlane with an E. We get a lot of timberlands. We're not Timberland. We're Timberlane.
Okay.
So timberlanepartners.com, and if you go to our website, you'll find all of our information there.
John Chaffetz, ladies and gentlemen of Timberlane, thank you so much.
Hey, thanks so much for having me. It was a lot of fun.
Awesome.
Appreciate it.